Most rejected returns aren't tax law problems, they're intake problems. Your job is to lock down identity data and use last year's return like a roadmap. On the EA exam, they love questions where one missing digit in a TIN or one ignored carryover changes the whole answer. So think of intake as two tracks: verify who's on the return and verify what's carrying into the return. Start with the prior year return. A preparer is expected to review it for compliance, accuracy, and completeness, but the exam angle is simpler. What items flow into the current year? Look for carryovers like capital loss carryovers, charitable carryovers, and credit carryovers. Also watch for net operating losses, prior year minimum tax credit, and anything tied to depreciation and asset basis. Those don't reset each January. Depreciation and basis are where intake mistakes get expensive. If last year shows a Schedule C or E with assets, you need the depreciation history, not just this year's receipts. If there was a sale last year, basis may have changed. If there's a partnership or S corporation K1, basis tracking can affect loss limits this year. Exam tip: when you see prior year return provided, assume it contains clues you must use. Next, lock in required biographical data. You need legal name, date of birth, marital status, residency or citizenship status, dependents, and a taxpayer identification number for every person listed. Best practice is to actually see documents: a photo ID with current address, social security cards, ITIN letters, or other proof. And then slow down and transcribe carefully. One wrong digit is one rejected e-file. TINs are a favorite testing point. The IRS requires a valid TIN for the taxpayer, spouse, and each dependent on the return. The three you'll see are SSNs, ITINs, and add-ins. Generally, U.S. citizens and work-authorized non-citizens can get an SSN. If someone can't get an SSN, they may need an ITIN, and an add-in is a temporary number for a child in a pending adoption when an SSN can't be obtained yet. Here's a weird but very testable exception. A child born and deceased in the same tax year with no SSN issued may still be claimed as a dependent. But you can't e-file that return. It must be paper filed, and you attach a birth certificate or hospital record showing the child was born alive. On the form, you enter died, where the dependent's SSN would normally go. Stillborn infants do not qualify. Finally, make sure you're using the right individual return form. Most clients are on Form 1040. Seniors may use 1040 SR, but it's still basically a 1040. Non-resident aliens generally use 1040 NR, and if you're fixing a filed return, it's 1040X. This matters in intake because residency status and filing history drive the form choice, and the wrong form can derail the whole engagement. All of the following statements regarding the Adoption Taxpayer Identification Number, the add-in, are correct except one. The choices say, an add-in can be used for certain domestic or foreign adoptions. An add-in can be used to claim any tax credit available with an SSN. An add-in can be obtained before an adoption is finalized. And an add-in can be requested when you can't secure an SSN until finalization. Think about it. Which statement is not true? The incorrect statement is that an ITIN can be used to claim any tax credit available with an SSN. That's the trap. Certain credits commonly require a valid SSN for the child, so an add-in won't unlock everything. The other statements fit the purpose of an add-in. It's a temporary number used when an SSN can't be obtained yet during the adoption process. Gordon is 65 and lives with his son and daughter-in-law. He's retired, and his taxable pension income for the year is $12,000. Gordon doesn't plan to file a return. The question is, can the son and daughter-in-law claim Gordon as a dependent? The options include yes, no, because income is too high, yes if Gordon doesn't file, or none of the above. Think about it. The correct answer is no, because Gordon's income exceeds the gross income limit under the qualifying relative rules. His $12,000 taxable pension is too high, even if he lives with them, and even if he doesn't file his own return. The tempting wrong answer is the idea that as long as he doesn't file, you can claim him. Filing status doesn't override the income test.